Welcome to Buy, Hold, Sell. My name is Matthew Kidman and the Australian share market has been on fire. Since February, the market has rallied more than 15% just when we thought the world was going to end. Joining me to discuss whether there is still value in this market is Stuart Jackson from Montgomery Investment Management and Steve Johnson from Forager. Steve, I'll start with you. Market's had a tremendous rally. People are getting wealthy when they were all bearish, which is always nice, climbing that wall of worry. Is the market expensive or are there still pockets of value we can find out there?
I don't think the overall market is stupidly expensive, particularly in this interest rate environment that we are in today. And I think buying a well-diversified portfolio of equities will probably do you reasonably well over the next 10 years from here. What has changed for us is that the market has got a lot more level. This time last year, we had a portfolio of stocks that we were really excited about.
Yep.
The overall market hasn't changed that much since then, but our portfolio is up 30% and we're finding it a lot harder to find the new opportunities to put in there. So you're faced with this dilemma at the moment. You can pay really expensive prices for stocks that are going to grow quite healthily, or you can pay okay prices for the boring businesses that aren't going to grow. There's not a lot out there that's super attractive to us.
All right, before we leave you, I'm betting you're going to do another 30% in the next 12 months. So where you're positioning your portfolio to get that? Is
that
it
will
in
take
those
some effort from
okay
30%
price for
cash?
an okay business, or is it the expensive stocks? Give us some sectors.
Look, we're still trying to find the left behind opportunities and some of the stocks at the smaller end of the market. And it's a pretty diverse spread of them at the moment. We've still got some mining services stocks that I
Which you picked
really
really
like.
well.
Yeah, a lot of it's rallied. We've sold some of it, but we're still finding some opportunities that are out there. And then just a few industrial businesses that I quite like. Reckon being one of those, accounting software player that's been left behind.
Okay, Stuart, interest rates very low. In fact, they're going lower in Australia and New Zealand. The US is trying to lift them. Everyone's, they've been, the reserve banks around the world have been the whipping boy for this rally. Does that mean we have to buy equities with rates so low?
No, not really. I mean, the manipulation of risk-free rates by central banks around the world doesn't necessarily change the dynamics in terms of risk. So if you think about the cost of capital for risk assets, just because risk-free rates come down does not mean that actually the return on capital should come down for risk assets. It just means that there's a shift effectively in risk aversion effectively. Now, from our perspective, we've resisted the urge to actually reduce our discount rates and our required rates of return on assets. And that's primarily because when you start actually adjusting your risk premiums down, what you're effectively doing is you're giving into the manipulation of the government and the adjustment to the price signal that they're actually pushing through the marketplace. And that leads to misallocation of capital. I mean, we are a capitalist society. The price mechanism is supposed to allocate capital efficiently. When you're talking about governments manipulating interest rates around the world and the price signal for capital for many, many years, invariably it's going to lead to misallocation of capital. So we're trying to avoid that as best we can as well.
Okay, so in layman's language, that means things have got more expensive because people are up the risk curve. So does that mean we stay out of the market, we add to our cash levels? Does it mean that if you're able to short or you can go to another asset class, that's the place? What's the best way of addressing what you've just
Well, from our perspective,
outlined?
we retain our core philosophy of investing in good businesses with good prospects. So that means companies that have good returns and the ability to reinvest at that rate of return to drive and the compounding of the benefits of that as that flows through over a longer period of time. Those stocks have performed very, very well over the last 12 months, particularly in the back half of the last calendar year. And so it's become much more difficult to find value in those high quality names. So from our perspective, that naturally leads to a reduction in our investment levels and a rise in our cash, waiting for better opportunities in the future.
All right, Steve, just going back to you, let's go to the big end of town. So some of the sectors that have been left behind a bit, those opportunities that may be around. We've got the banking sector. It was expensive 2 or 3 years ago. Stocks down 20 and 30%. We've had the big consumer staples, Woolworths in particular, badly managed, stock down, opportunity. Do you see value in any of those kind of names?
So I'm not seeing any stocks there that are meeting our return criteria, which is pretty high. We run a concentrated small fund and we have the ability to invest in things that are going to give us a high return. We're not seeing things that meet that criteria at that end of the market, but I think for the average investor out there, they're losing confidence in that part of the market because it's been such an underperformer, and I think they're losing confidence at the wrong time.
Yep.
And they're forgetting about some of the benefits. So these businesses are not going to generate you double-digit returns, but if we have a recession, if the economy gets into trouble, if things start going wrong, People keep buying their groceries and they keep paying their electricity bills, and some of these businesses will keep paying you dividends and performing well. And I think in this headlong rush into the smaller end of the market, people are forgetting about some of those benefits. So there's good enough value there to be the core of most people's portfolios.
Okay, let's assume rates stay where they are. Central bank's not going to move too much, especially on the upside. What can the market deliver us, say, in the next 12 months? A total return of?
No idea. I honestly have no idea. If you'd asked me a year ago, I wouldn't have had the faintest what it was going to deliver. I think we're priced long term to deliver lower than it has historically. You know, we're paying higher prices today. The historical return from equities has been in that 8 to 10% range. I think you're probably in 6 to 8 now. And across a balanced portfolio, you probably could have expected a 6 to 8% return historically. That number is now 4 to 5. And I think a really important thing for all investors is to reduce those expectations so they don't run off going up the risk curve, but they sit there and say, okay, my expectations need to be lower.
Okay, Stuart, let's hear where you might want to go long, because most of us out there are long investors, so there must be a couple of stocks that are worthwhile buying.
In the big end of town, we actually do struggle with it a bit because they don't really have the ability to reinvest in their businesses to grow on a longer term basis. We like the longer term thematic associated with the transition to booming baby boomer generation from wealth accumulation to retirement and income requirements. So something like Challenger from a growth perspective is one we like. Having said that, what I would be cautious about is overexposing yourself to financials which have a lot of exposure to financial asset valuations in the marketplace. And yes, Challenger has a bit of that, but the banks are another side of this as well. So, you know, when we look at the banks, there are 5 essential drivers of value with those. With the banks, there's the loan book growth. Growth in loan book historically has largely been driven by greater levels of gearing as interest rates have fallen. The outlook for that obviously is diminished going forward. You know, you're not going to have the economy gearing up as fast as it has over the last 20 years. Net interest margins are under pressure because of funding costs and increased focus by APRA on liquidity requirements and so forth. They're going to keep that under pressure, as well as competition. Then you've got the provision side of things. That's where the asset quality comes in as well. And then you've got the last of all, you've got they've got the cost line, which is really going to have to take up the running in terms of driving earnings for these companies. So a lot of focus on that going forward. And APRA is increasing the capital requirements for these guys, so the marginal return is going to be lower on a marginal percentage point of growth for these companies. So they need to be derated on that basis because they're going to generate less surplus capital on a go-forward basis. So from that perspective, we don't really see huge value in the banks either, even at these sort of levels. They're about fair value. But you know, when you're looking at things like Woolworths and so forth, we think that one's got further to correct as well in terms of the structural change in that marketplace.
So there's not much out there. So the bears are really climbing that great wall of worry.